What if the biggest financial decision you ever made wasn't your job, your degree, or even where you live, but how much debt you decided to tolerate? Not take, not avoid, just tolerate. Because most people don't wake up and choose debt. They slowly get used to it. Scene 1. Early life. Student debt. You're 22, maybe in the US, maybe in the UK, maybe somewhere in Europe. You graduate with a degree. There's a sense of relief and a quiet number sitting in the background. $30,000, $50,000, sometimes more. It doesn't feel real yet because the payments haven't started. So you move to a city, you get your first job. Let's say you earn $3,500 a month after tax. Rent takes $1,200. Food, transport, basics, another $800. You're left with $1,500. And then the student loan email arrives. $300 a month. It feels manageable, so you don't really question it. You just adjust. Scene 2. Mid-20s. Lifestyle expansion. A year passes. Your salary increases slightly, maybe $4,000 after tax now. But your life expands too. You move into a better apartment, rent is now $1,500, you upgrade your phone, you start traveling a bit more. And then comes the car. Not because you deeply analyze the cost, but because everyone around you has one. The payment? $400 a month. Insurance? Another $150. Now your fixed monthly structure looks like this. Rent, $1,500. Student loan, $300. Car plus insurance, $550. Living expenses, $1,000. You're at $3,350 out of $4,000. You still have money left, but something has changed. You no longer have flexibility. You have commitments. Scene 3. Late 20s. Credit layer. This is where debt becomes invisible. Because now it's not one big loan, it's multiple small ones. You start using credit cards. Not recklessly, just occasionally. A dinner here, a flight there, something you'll pay off next month. But next month comes and something else replaces it. Now you carry a balance. $2,000, $4,000, sometimes more. At 18 to 25% interest. And here's the part most people don't calculate. If you carry a $5,000 balance at 20% interest, you're paying about $1,000 a year just to stand still. No progress, no asset, just maintenance. Scene 4. Early 30s. The stable trap. Now your income is higher, maybe $5,500 a month after tax. On paper, you've made it. So you upgrade again. A nicer apartment or a mortgage. Better car, more subscriptions, more expectations. Your financial life now looks stable from the outside, but internally it's tightly packed. Mortgage or rent, $2,000. Car plus insurance, $600. Student loan, $300. Credit cards, $200 minimum. Living costs, $1,200 plus. You're left with very little room. And that's the trap. Because nothing feels broken. You're paying everything on time, but you're also not moving forward. The hidden system flaw. The system isn't designed to make you fail. It's designed to make this feel normal. Each layer of debt is introduced at a moment that it feels reasonable. Student loans feel like an investment. Car payments feel like convenience. Credit cards feel like flexibility. Individually, none of them seem dangerous, but combined, they quietly reshape your entire financial life, not through one big mistake, but through a series of acceptable ones. The simple math most people avoid. Let's step back. Imagine you're paying $300 student loan, $600 car, and $200 credit cards. That's $1,100 per month. That's $13,200 per year. Over 10 years, that's $132,000, and most of it didn't build lasting wealth. It maintained a lifestyle. Psychological layer. Why this happens? This isn't about discipline. It's about perception. Humans don't naturally think in totals. We think in monthly terms. $300 a month sounds manageable. $132,000 over time feels abstract. So we optimize for comfort today and ignore structure over time. There's also social pressure. Not direct pressure, but ambient expectation. You see what others have. You align without realizing it. Not to impress, but to belong. Long-term impact. If nothing changes, something subtle happens. Your income grows, but your obligations grow with it. So your financial position stays roughly the same. You earn more, you spend more, you owe more. And time passes. 10 years later, you're financially older, but not significantly freer. Shift in perspective. How financially intelligent people think. Financially aware people don't avoid debt completely, but they treat it differently. They don't ask, can I afford the monthly payment? They ask, what does this payment do to my future flexibility? They see debt as a reduction in options, not just a cost. They understand that every fixed payment is a piece of your future already decided. So they move slower, not out of fear, but out of clarity. Closing. Calm, grounded tone. Debt isn't always a crisis, but it is always a structure, and your life eventually adapts to that structure. The question isn't whether you have debt. It's whether your debt is quietly deciding your future, or if you're still deciding it yourself.